Before we begin, let me tell you this video isn't for everyone. No flashy edits, no hyper-stimulated nonsense, just actual ideas. Only 30% of viewers make it to the end because this isn't brain rot. If you do, you're part of a rare few in today's short attention span wasteland. You think deeper, you focus, you're probably going to do great things. Now, if you want to support content that respects your brain, try Audible free for 30 days using my link in the description, or use my affiliate link when you buy a book. It costs you nothing, but helps a lot. Let's get started.
Most people assume the odds are fixed, whether in a casino or on Wall Street. But Edward O. Thorp didn't. A mathematician with a restless curiosity, Thorp saw games of chance and financial markets as systems that could be analyzed, tested, and ultimately mastered. He wasn't interested in luck or speculation. He wanted to know what could be proven and what edge could be gained by thinking statistically, managing risk, and acting with discipline. Thorp didn't come from wealth or privilege. He built his life around ideas, not credentials, and followed a path from chalkboard equations to real-world results. Along the way, he invented card counting, designed the first wearable computer, and launched a hedge fund that quietly outperformed nearly everyone, using logic and numbers, not flashy predictions. It all began with a curious child, a Sears catalog, and a determination to understand the true meaning of a million. The early curiosity that shaped a mathematician. When Edward Thorp was 5 years old, he decided to count to 1 million. He chose the Sears catalog, packed with pictures and product codes, as his tool, treating every circled letter beside an item as a single countable unit. After hours of careful tallying, he fell asleep somewhere in the 32,000s. The next morning, he woke up and calmly resumed at 32,577. That small, stubborn experiment captured something key. He didn't just want to know what 1 million meant. He wanted to experience it, and to prove to himself that such a feat was possible. Thorp grew up during the Great Depression, in a family scraping by on his father's modest income as a bank security guard. He had few academic advantages, but he had something far better: a restless mind and a habit of checking things for himself. By 3, he was testing warnings about hot stoves and breakable eggs. By 5, he was calculating square roots and scanning price catalogs to practice arithmetic. When he overheard a shopkeeper adding up a bill, he mentally checked the total and corrected the man, who laughed and gave him an ice cream cone for his trouble. He also taught himself to read at a remarkably high level early on, devouring Gulliver's Travels and A Child's History of England, which earned him the surprise challenge of naming all the English monarchs and their reigns on the spot. He did it without blinking. His memory was strong, but more importantly, he used it to recognize systems, patterns, and structure in the world around him. And when something didn't make sense, he tested it. Thorp wasn't driven by competition or praise. He simply wanted to understand how things worked. That innate investigative mindset became his greatest asset. What started with catalogs, numbers, and puzzles would soon evolve into calculated attacks on games of chance. Breaking blackjack with statistical precision. In 1961, Thorp walked into a Reno casino and quietly started winning at blackjack using a system he had proven in a university lab. What the dealers didn't know was that every bet he placed had been pre-tested through thousands of simulations on an IBM 704 computer. Casinos believed blackjack couldn't be beaten. Thorp had already shown otherwise, armed with mathematical certainty. It started when he began analyzing blackjack as a mathematical system. He realized that unlike roulette or craps, blackjack had a memory. The odds shifted depending on which cards had already been played. That meant it was possible to keep track of those changes and adjust your bets accordingly. Thorp developed a card counting system that let players do exactly that, giving them a measurable edge over the house. At first, even fellow mathematicians were skeptical of his claims. So he built his own blackjack simulator in the programming language Fortran and ran millions of hands through it to test different strategies. The data was clear. His approach worked. To verify it in the real world, Thorp visited casinos in Nevada with a small bankroll, often disguising himself and varying his bet sizes based on the count. When he started winning consistently, the casinos noticed. Some shuffled early to throw off his count, others threw him out. But the strategy had already been published, and soon card counters were showing up at tables across the country, much to the casino's chagrin. While blackjack got the most attention, Thorp didn't stop there. He worked with Claude Shannon, the celebrated pioneer of information theory, to build a wearable computer, one of the first of its kind, that could predict where a roulette ball would land. Their device gave them a significant edge, but it proved hard to use discreetly in practice. What made all of this possible was Thorp's willingness to test ideas against real outcomes and to manage risk carefully. That same precise and disciplined mindset would soon be turned towards something even bigger than casinos: financial markets. Discovering hidden patterns in financial markets. When Thorp started studying the stock market, he noticed something familiar. The pricing of warrants, contracts that give the right to buy stock at a set price, showed patterns that reminded him of blackjack. He understood that, like the cards in a table, the numbers weren't random if you knew what to look for. He realized that the same statistical reasoning that gave him an edge in the casino could also be used to spot mispriced assets in financial markets. At the time, most investors were relying on instinct, reputation, or vague economic theories. Thorp took a different route. He built mathematical models to value securities, tested them against historical data, and calculated the odds of various outcomes. One of his first targets was a mispricing between a company's convertible securities and its common stock. By setting up a carefully hedged position, long on one, short on the other, he could profit with minimal risk, regardless of market direction. Thorp's early success in applying probability theory to finance caught the attention of professionals, including a meeting with Warren Buffett over a bridge game. While they didn't end up working together, the conversation confirmed for Thorp that disciplined, rational strategies had a place in investing. Soon after, he partnered with Jay Regan, a businessman with Wall Street connections, to start managing money more formally. They launched Convertible Hedge Associates in 1969, which would later evolve into Princeton Newport Partners. The methods were the same in spirit as blackjack: find a quantifiable edge, manage the downside, and scale carefully. But the stakes were higher, and the environment more complex. Finance didn't offer the same predictable rules as a casino, but it did offer exploitable inefficiencies, and those could be measured, modeled, and exploited. With the basics of a new kind of investing in place, Thorp was ready to build something bigger. Building a math-driven hedge fund from scratch. In the early 1970s, Thorp was quietly running a hedge fund that almost no one in the financial press had heard of. Yet its results consistently outperformed the market while taking on far less risk. The firm was called Princeton Newport Partners, and it was built on a methodical approach relying entirely on mathematics, not market predictions. Thorp wasn't following trends or betting on companies. He was isolating pricing errors in complex securities and using statistical models to profit from them. What made the fund so unusual was how carefully it was hedged. Thorp's team found opportunities where a security was misplaced relative to another, typically convertible bonds, options, or warrants. They then set up matched trades that would cancel out most of the broader market risk. The profit came not from guessing where prices would go, but from exploiting the gap between established financial theory and actual market behavior. They tested every strategy, measuring the expected gain against any potential worst-case loss, and followed strict rules about bet sizing. As the fund grew, it attracted more attention and more capital, but it also attracted complications. Regulatory scrutiny increased, and while Thorp maintained strict legal and ethical standards, one of his business partners became entangled in unrelated criminal investigations. Though Thorp himself was never accused of wrongdoing, the association became a burden. He made the decision to shut down the firm in the late 1980s, walking away from a highly successful operation. Despite the quiet ending, the impact was long-lasting. Princeton Newport had demonstrated that markets could be approached much like a mathematician tackles a game, with strategy, discipline, and a clear edge. The experience deepened Thorp's understanding of how markets behave under pressure, and it sharpened his eye for hidden risk. That insight would shape how we thought about both money and uncertainty in the years ahead. Learning to navigate risk in the real world. By the late 1980s, Thorp made a small fortune by noticing something most investors missed. As fears about the banking sector spread, he realized that bank stocks had been beaten down far more than their fundamentals justified. He began buying them aggressively, and when the panic faded, the rebound was fast and lucrative. The trade reflected exactly how we like to operate, by assessing the odds, planning for downside risk, and making decisions based on reason rather than emotion. After closing his hedge fund, Thorp continued managing his own money, often finding mispriced opportunities during moments of market stress. But during this period, he also became increasingly aware of how easily investors could be misled, whether by volatility, flawed models, or even deliberate fraud. He encountered schemes that promised consistent, outsized returns, often wrapped in the language of sophistication, and sometimes backed by respected names. Most of these simply didn't add up. He stayed clear, but he paid attention to how these scams worked. He also observed that many investors weren't failing because they lacked information, but because they misunderstood risk. One of his core beliefs was that long-term survival matters more than short-term gain. He used the same logic he'd applied in blackjack and derivatives pricing. Measure your edge, assess your downside, and never bet more than your bankroll can handle. He watched as others ignored those principles, often with painful results. Even with his strong background in mathematics, Thorp never assumed he had all the answers. He learned to spot systemic weaknesses, like over-reliance on leverage or blind faith in market stability, that could undo even the best strategies. His focus shifted from maximizing returns to identifying the hidden dangers and assumptions people trusted too easily. What came next was a set of ideas for how to grow and preserve wealth without relying on forecasts or financial gurus, and how to help others do the same. A Mathematician's Guide to Growing Wealth Safely. When Edward Thorp was asked how much money someone really needs, he always offered a calculation. His thinking was always rooted in probabilities, and he approached personal wealth the same way he approached blackjack or hedge fund strategy, with a focus on the numbers, the odds, and the compounding effects over time. Rather than chase high returns, Thorp emphasized avoiding losses and letting compounding do the heavy lifting. He explained that growing wealth steadily over time beats trying to double your money quickly and risking disaster. He used the example of the Kelly criterion, a formula originally developed for telecom signal optimization, to determine how much to bet or invest when you have an edge. Invest too little and you underperform. Too much and you risk losing everything. It's a balancing act, and he stuck to it rigorously. He also made the case for index funds well before they became mainstream. His analysis showed that most active investors underperform in the market, even professionals. For the average person, buying broad market index funds and minimizing fees produced better results than trusting stock pickers or trying to time the market. He saw this as an extension of what had always worked for him: finding the edge, staying disciplined, and avoiding emotional decisions. Thorp applied this thinking to every part of financial planning, from how to allocate assets, to when and how to take on risk, to determining how much is enough. He treated money as a tool that could be grown and protected with logic and patience. His approach was accessible, but deeply grounded in math, built to work under uncertainty. With his own finances secure, he turned his attention to how this kind of thinking could help others, and what responsibilities came with that freedom. Choosing independence over fame and fortune. The day finally came when Thorp stopped managing outside money. This gave him the freedom to think, to give quietly, and to stay independent. This was more valuable than any headline or billion-dollar fund. After decades of using mathematics to gain an edge in games, markets, and systems, he was most interested in how those same ideas could improve lives. He believed the rational principles that helped him build wealth could also guide how one might best use it. Thorp gave to causes that aligned with his values: science education, rational decision-making, and organizations that used data to measure real-world impact. He supported university programs and independent researchers, always preferring low-profile action over public credit. His goal was to contribute where he could see the effect, not just spend for status or recognition. Looking back, he also took a hard look at how financial systems had evolved. He saw repeated patterns of overconfidence, poorly managed risk, and crises that punished ordinary people more than the institutions that caused them. What frustrated him most was how often these failures could have been avoided with basic statistical thinking. He believed that a more educated public, especially in math and finance, could help prevent future damage. Thorp's final reflections are true to the logic he had followed his entire life: avoid ruin, keep learning, question assumptions, and understand that small, consistent advantages compound into big outcomes. He never claimed to have perfect foresight, but he trusted the method, used the best information available, run the numbers, and act accordingly. That mindset helped him beat the odds and gave him a life he didn't need to escape from. For Thorp, success wasn't defined by how much he earned, but by how well he understood the risks, and how wisely he chose to use the rewards.